All right, welcome back. I hope you're having an awesome time so far. Our next speaker is Laura Kraft. She is the head of global ESG strategy at Heitman. Please join me in welcoming Laura to our virtual stage.
Thanks, I really appreciate that and glad to be here today. I'm going to share my screen. So let me get that. So today I am talking about ESG. Some of you may have heard that terminology before, and what it stands for is environmental, social, and governance. It can be a pretty confusing world with ESG, so hopefully I can help decipher that today. I work for Heitman. We're a real estate investment manager. We invest globally and in private equity, private debt, and public equity. We do believe that ESG can influence investment returns, and so our mission statement is we invest today with a focus on tomorrow, incorporating ESG into our investment decision-making process. So ESG, going in a little bit further, E, S, and G mean something completely different. I sometimes question why they are all lumped together, but I think why they are all lumped together is because they are non-financial metrics that impact investment decisions and investments overall. So E means that you're focused on clean energy, climate mitigation, social. That's where the DEI initiatives are diversity, equity, and inclusion. Your health and well-being initiatives. Governance is around your corporate structure, your ethics, policies that you have in place. And so again, E, S, and G are wildly different, yet they get grouped together, and you see that in the listed market there are a lot of funds that call themselves ESG funds. Does that mean they're good in E, S, and G, or does that mean they're good in E and maybe not so much in S and G? And so I think that that's where a lot of confusion comes into play, is because these are different topics. When we're talking about ESG funds, as I just said, there's different kinds of approaches. Traditionally, investments may even consider ESG. And so that would be kind of that first bucket of not focusing on ESG as part of that investment process. The second would be you're thinking about ESG, you consider it when it's material, you incorporate it then when it's material, but it's really ad hoc and not systematized. The third strategy around ESG investments is it's included in your investment strategy. It's systematized. It's just part of how you do things. You are more of a traditional investor, but you do take into account how ESG plays in that investment decision. Your fourth is your full-blown, you are investing with returns in mind, but also with a goal of enhancing ESG, some sort of thematic ESG topic. So, for instance, it would be investing in affordable housing, because and that affordable housing had returns, but it is also helping to lessen the housing crisis, helping with affordability. And so it has a social focus along with that investment focus. So that would be an example of a thematic ESG investment. So this slide, I just talked about, all right, ES and G are wildly different, and we just talked about the different ways that you can invest in ESG. And this slide breaks down how ESG, if you were to say, what is Heitman doing ESG-wise? Well, there's the company Heitman, what we're doing at a company level, and then there's what we're doing at the investment level related to ESG. So at a company level, we're focused on our environmental footprint. We have our own diversity, equity, and inclusion goals. We have a global management committee in place. We have all those things. And so my focus is on the investment side. How does ESG impact our investments? And some of these topics are listed on the right-hand side. How does climate risk impact our investments? What about the human rights protections and COVID-19 and last year, 2020? How are we ensuring that our properties are properly ventilated and safe and healthy for occupants to enter? And then going down into the governance side is how are we managing these assets? What policies and procedures and guidelines are we following? It's not just about what we're doing in the private equity side. It's also about how are we screening our partners, our JV partners or companies that we're investing in on their governance practices. So again, this is just breaking it down a little bit further. It's also important to note that ESG varies by investment product, so the materiality of it. When we're investing in private equity deals, we're in control of the governance. We're in control of what policies, procedures get implemented. So that's less of a worry for us. What's more of a worry on the private equity side is the environmental aspects. So climate risk, how much climate risk does an investment have? How are we going to manage that? How are we going to increase the efficiency of the asset, the resource efficiency? From a private debt and public equity perspective, most of the work is done up front from the investment lens. It's around assessing our partners, assessing what we're going to invest in on the governance. So governance is actually a bigger, it stands out in that ESG component. To give you an example, private equity space, when we're investing in listed companies, listed REITs, we give every single listed REIT an ESG score. It's a composite score, but ESG is not weighed equally. The governance accounts for 60% of the score, environmental 30%, and social 10%. So again, it's wildly different. Private equity space, environmental is the most important, and then social, but governance is something that we control. So again, this is why ESG can be so confusing, because there are so many different layers and facets to what it means and how it applies. So why does ESG matter? If you're talking to a European investor, they don't know the difference between ESG metrics and financial metrics. So we've come a long way that the role of these metrics are increasingly important to investors. So is it really a nice to have ESG, or is it a must have? And in my role of being focused on ESG, what I've seen is ESG is more about managing risk than going after opportunities. I tend to see that there's more of a brown discount of not having something than you getting a green premium. And a perfect example of this is looking at listed REITs, and this is the governance score. So we see that there's a link between governance scores and company valuations. And what we see is that there is a positive side for those companies that have higher governance scores. You get 130 basis points premium, but you get even larger discounts if you are, don't score as well in governance. You get 280 points, negative. So this is where you see that when we're thinking about these ESG factors, it's not just a nice to have. I think it's creating a baseline, and if you don't have it, then you could be penalized for not having it. So again, I think that there's more of a brown discount. We also see that those companies that are focused on ESG transparency tend to have better performance. There's some positives that you get for having this kind of transparency. You have lower cost of capital, better operational performance, and then the listed side, better stock price performance. So again, it's important if you're a company to think about these ESG metrics and have transparency with your investors on it. I wanted to switch gears to environmental. So environmental risk can impact pricing in the private equities, in the direct investment and real estate side of things. This is an example where an asset, may not have physical damage from a hurricane, but it's in a market that had a hurricane come through it, and that property had decreased in investment value by 6% 1 year after the storm hit and 10.5% 2 years after. So again, this was a market study. So how did the market perform? And again, the whole market overall was dropped 6% and 10.5%, regardless of whether the property had damage. So this is just going to show that climate risk is investment risk. And to reiterate that further on where climate risk could impact your investment, it can impact it from the market perspective and then, at your property level. So we're seeing that, you could have increased discount rates because people could view your property as more risky. We're also thinking about, in 10 years from now, if you're a 10-year hold, kind of company, what is the market, how is it going to price in climate risk? Are you going to have higher exit cap rates because of this increased risk? We're starting to see that lenders are charging more in rates, so higher loan rates. All these things mean that it will impact your property value to the negative. There's also risk at the property level. If you are in a place where there is climate risk and events do happen, then you could experience higher wear and tear on the building, which would increase your operating costs. We're seeing that insurance rates are going up. Real estate taxes could go up as well to fund infrastructure in the area to help mitigate the climate risk. So again, these things are going in the wrong way and they could impact your property value in the negative. So let's switch to the positive. So ESG also have opportunities. So if you are a direct real estate holder of an asset, there are things that you can do in ESG wise that can help enhance your property values. From the environmental perspective, we all want to lower the operating expenses, so lower the resource use of energy, water, and waste, and you could help lower those operating expenses. From a social side, we want to create a stickier resident, a stickier tenant. And when we do that, we can, have higher satisfaction at the asset, have lower downtime, lower turnover, which would mean that you would have higher rental revenue for the property. Again, all these things would increase your property values. And if you're owning the asset outright, then you can just have a standardized governance. And so you're managing that risk that there's, that the property is abiding by your guidelines, your rules, and it won't trip you up. So again, it's a way to increase property values. Just to bake it all together, so this is the valuation of how we look at the private side and the public side. So if you were investing in a listed REIT, this is how ESG gets baked into it. The left-hand side is if the real estate portfolio itself. So ESG is baked into that portfolio. Some of the earlier slides covered how that gets baked into that portfolio valuation. We're also valuing the company as a whole. And so that ESG gets baked into that management. So how we're looking at the overall enterprise. So it's fascinating to see that, there's two different ways that ESG can be baked back into a listed REIT valuation. And I have one last section, which is why is ESG on the rise? So if you're looking at the public listed funds, there's a rise of ESG funds. What's really interesting is that you see that the biggest ESG funds are beating the market. They're beating their peer funds. And this is great news. I think they're managing risk better than some of their peer funds, which is meaning that they're having better risk-adjusted returns. And I love this quote that, is over on the left-hand side that one of these managers used to always get asked the question of, aren't you limiting returns or sacrificing returns by focusing on ESG? And right now that manager doesn't get that question anymore. So that's fantastic. So again, there's a reason why folks are focused on ESG. And I also found this to be interesting. This was last year, 2020, of how is ESG, since if it's a nice to have, how is ESG going to perform in COVID times? And actually we found that ESG surged because investors were searching for better corporate citizens. People were looking to invest in things that aligned with their values. And so I think that ESG will only continue in its trajectory. And we see this. This is the demand for ESG funds increasing. So we look at 2018, it almost looks like half of 50 billion. And we go to, the fourth quarter of 2020 and it was 150 billion. So it's just on a curve up in terms of how many inflows there are to ESG funds. So, I'd love to see this graph and then over the next few years and how it evolves. And you may ask again, this is another chart showing how ESG funds are outperforming their peers. And this is broken down by equity, fixed income, and alternatives. And so you see that for those funds that are in the equity space, they're getting higher. The ESG funds are really outperforming. The fixed income ones are not as outperforming as the equity ones or the alternatives. And I think that's because the equity, again, the equity investor has more control over the asset, the operations, whereas the fixed income, it's a little bit more of a passive strategy. But we're still seeing that ESG funds are doing very well in comparison to their peer funds. So just to wrap it all up, what is the future? I really do think that the future of companies and the future of investing is this profit plus purpose. The combining of the financial metrics and these ESG, these non-financial metrics. I do think that ESG is really confusing. If you listen through this whole deck today, you've heard that there's different type. E, S, and G stand for something radically different or pretty different, yet they get grouped together. And so you can have a fund that's great on E, but maybe not on S and G, but yet score high on E, S, and G. So there's some things I think that need to happen. But overall, I think that we have a more aware investor today. And these aren't going away, that there are changing social norms and how people are investing. And we see that there is, this positive association with ESG investing and investment returns. The better risk-adjusted returns, because again, it's protecting it against the downside. But then there are also opportunities. So, and we see this stat over here too, that a lot of pension funds and insurance companies are looking for strategies that are in that fourth category that I mentioned earlier in this impact investing thematic approach of ESG. So again, I think we're just at a tipping point of ESG taking off and it becoming more of a commonplace normal. If we think about the term ESG, it's only been around in the past 15 years and really only prevalent in the past 5. And, I think that there's still a lot of people out there who don't know what it means, but, it is on the rise. And, I think it's wise for everyone to be educated on what it is. And also, how it can be confusing and trying to separate it out as much as you can, so that you can actually see that positive correlation between whatever material ESG factor you're focused on and your investment strategy. So with that, I thank everyone for joining today, and I hope you learned something.
Wow, thank you so much, Laura. This has been awesome. And I know this virtual audience is giving you a huge virtual round of applause. That was awesome. Thank you for sharing your perspective with us. For the audience, it's time for you to make your way to your next session. Along the way, make sure you accept your connection request and take some time to check out our amazing exhibits. Thanks so much, and we'll see you around.